In this week's update, what drove prices and what to look for next week. It all gets down to inflation, real or imagined. Gold was smashed, and we'll look at the Bitcoin chart as well. My name is Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. What a horrible week if you're in growth stocks. And I've been saying for a while now that markets would likely split significantly as we go forward, and stocks with a great future would do really well, and the rest would probably struggle. We're now in a correction period that's been triggered by a spike in long-term bond yields, but it's important to understand what is actually driving prices in the short term, because this is a very, emotional period. It's one where you can, if you're not clear on what you're doing and perhaps where the forces are pushing the market, you could make some unfortunate decisions. So that's what I want to look at today is just go through all of the factors that are impacting on the market and try and get a sense of what it all means. So what has been spooking the market of late and driving prices? I've spent a lot of time thinking about this and reading and researching, and this is what I've sort of distilled it down to. I think it's not where the 10-year bond yield has got to. It's not the fact that it's got to 1.5%, because that's still pretty low. I think the real nub of the problem here is that it's the speed in which the market has moved. It's the speed of the yield rises that has caused instability in the bond market. And the one thing that markets hate is uncertainty. And they've certainly been caught off guard with just how quickly bond yields have moved. I mean, it was only October or so last year that 10-year bond yields were 0.5%. Now they're 1.5%. Now it's in percentage terms, it's not a big move, but it's a tripling. And it's that speed of the real yield rise that has upset the market. And because the market is moving fairly quickly, the bond market I'm talking about, there's a frantic repositioning in the bond market that's causing everyone to second guess what comes next. And it's that confusion that is really the problem. It's being unclear about just how far and how fast bond yields are going to go. And then that was compounded by some pretty ordinary auction results. The US government trying to auction a large amount of, I think it was 7-year bonds, and there wasn't the normal acceptance of those bonds in the marketplace. And that, of course, can lead to yields rising even faster. So that sort of upset the market a bit as well. But look, one of the realities of modern day markets, and this has been the case for quite some time, is that about 70% of all trading is done by algorithms. And those algorithms are now in overdrive. But some of those algorithms are actually working off old themes and old relationships that I don't believe apply anymore. And just to give you one example, well, one of the old themes is that when interest rates go up, it's bad for technology stocks, because technology stocks have typically borrowed very heavily, and the rise in interest rates is going to really hurt them. Well, the problem with that is that's no longer the case. Corporate America in the last decade has deleveraged considerably, so companies are not carrying the debt levels that they used to. And the second issue is that was a problem when interest rates were 5%. That was the base, and then interest rates would go up from 5%. But when we're talking about companies that have borrowed at 0.5% or 1%, and then interest rates go to 1.5%, I mean, that's not the problem. But the algorithms don't see it that way. They just do what they're programmed to do. And so interest rates go up and technology stocks get sold. And you can't tell me that an improving economy, which is unquestionably what we've got in the States, the data is just very compelling, the economic data, and the corporate results, profit results are great. You can't tell me that technology stocks are not going to do well in that sort of environment. So at one level, I think that what we've seen in the last week and a half has been a gross overreaction. But before you feel relaxed about that, the market is what it is, and we can't just sit back and say, well, it's a stupid overreaction, we should ignore it. We can't afford to ignore it. We have to respect what the trend is saying. But just keep it all in perspective. And so for me, that tells me that I don't want to be overreacting to the situation. Now, the other part that I think occurred last week is, this goes on all the time, market makers stepped back and prices fell into a very thin buying market. And you can see that by the volumes. You look through a few hundred US technology stocks, and whilst the price movements were ugly, the volumes were generally pretty modest to low. So there wasn't a spike up in volume. So that tells me that the market makers are just stepping back, and the inexperienced people are panic selling into a thin market. So, you've just got to look at the market and respect what it's actually telling you. But having said all that, there's no question this is a dangerous time. There are extreme forces, particularly in the bond market, which then spills over into other asset classes, that are pushing in new directions. And so we cannot afford to sit back and say, well, it shouldn't be this way, because it is. But I don't believe that it's going to be sustained. I think this is a period of readjustment. Whether the selling is finished yet or not remains to be seen. But I think, as I said right at the start, we're now in a period where we're going to see the market split quite dramatically. The majority of stocks are going to struggle. They might go up a bit, they might go down, but the very best stocks are going to do extremely well. So what comes next fundamentally? So at the moment, bonds are short-term unstable. Will that settle down or not? That's really the big question. What the Fed has done in the past is that it'll try to talk the bond market into calming down. They'll tell them that they're going to do this and that. They're not actually going to do anything, but they're just going to talk about it. So the Fed will try to talk them down initially. If that doesn't work, then the Fed has two choices: raise interest rates, which is just not going to happen, or they're going to unleash basically unlimited liquidity. If you think we've seen unlimited liquidity in the past, I think the Fed will pull out all stops. And that will be just amazingly positive for so many asset classes. So raising interest rates or reducing QE is just not going to fly. You look at what happened in 2013 when the Fed talked about reducing the amount of QE. You look at what happened in 2018 when Jay Powell first came on the scene and started talking about raising interest rates. The market just fell over. So I think the Fed realises that those options are not on the table. So I think the most likely event is the bond market just settles down naturally, or the Fed is forced to really take out the big cannon and throw liquidity at the market like we've never seen before. And as I said, the consequence will be that stocks will probably take off if that were to happen. Now, I don't know which of those outcomes is going to be there, but I'm just kind of watching them all at the moment. So that's what comes next fundamentally. What then comes next technically? Well, in phase one, which we've just had, everything falls because it's panic selling. So it's completely indiscriminate. Good stocks, bad stocks, they all get sold off on emotion during that readjustment phase. But then we go into a phase two, where stocks that have got a great future, so the mega trend stocks, rebound because people recognise that the fundamental great story is still there and it's still going to unfold. And the rest of the stocks, probably don't rebound very much. Now, it's the nature of this rebound and the secondary high that will form from that tells the tale. If it's a really robust rebound, then I think we're probably going to be on a pretty good footing. But if it's a weak rebound, the candles are short, they're weak, they close well off their highs, the volumes are relatively modest, then we might be going down further yet once that phase two has played out. So that's a bit of a roadmap forward as to what to look for. And look, to be honest, at this point in time, I have no opinion on what the nature of this bounce is going to be like. There are too many really powerful forces at play here that are very unpredictable. So I'm just staying completely open-minded and just playing the market as it comes. But the market and the economic reality is this, and we've got to remember, this is the underpinning. No matter what happens in the next few weeks or few months, this is the reality. US GDP forecasts are now running anywhere between 4% and 7% growth in 2021, depending on who you want to talk to. That's the strongest in 40 years. That's a factual reality. The other factual reality is that US institutions have sold billions and billions of dollars in bonds because yields are going up, bond prices must be going down. So naturally the institutions are selling out of bonds. So they've got all this money on the sideline. Obviously, what are they going to do with it? A good slice of it's going to go into the equities market. They're probably just waiting to see how the dust settles. The next thing is that corporate earnings are beating estimates by big margins. And there is an almost record number in percentage terms of S&P companies that are beating estimates. So we've got more companies than ever beating estimates, and they're beating them by bigger and bigger margins. That again is the corporate earnings reality. US household incomes are rising at the fastest pace in a long time. So again, lots of money building up on the sidelines. We've got huge pent-up demand from the lockdowns. People have been restricted from living life the way they normally live it for a year. And as the economy starts to open up again, there's going to be huge pent-up demand to spend money on all sorts of things. So I think we need to see the nature of this inevitable rebound. There's always a rebound. And we need to see how that plays out to get a sense of what comes next. So that's the backdrop. Let's look at a few charts to start with. And I must remember to just to go to the Bitcoin chart as well. But look, these are some of the key relationships that I'm watching very, very closely. So this is consumer discretionary versus consumer staples. And we saw what happened whenever the market panics. This was the COVID crash last year. You can see that the staples did much better than discretionary. So that's what you'd expect. So we got a short, sharp smashing of discretionary stocks, but then the normal trend resumed in an expanding economy, and consumer discretionary outperformed. That's what this rising line here is. Now, just in the last week, you can see week or two, we've plateaued out, and consumer discretionary stocks in the short term have underperformed, which is, again, what you'd expect. So the question is, how much further does this relationship continue? Does this continue right down here and start to break these sort of support levels? Or does it turn around fairly quickly and head back up again? That's an important one to watch because that tells you the sentiment of the market. The other really key one is growth versus value. So this is the Russell 1000 growth stocks versus value. And again, this is where growth outperformed value. And that peaked in August of last year. Since then, we've just gone sideways, which is, I recall saying about 3 or 4 months ago in one of these videos that was probably the way it was going to play out, that we would reach a point of stability and then we would go sideways. Well, now the bond market taking off has sort of changed that, and we've now broken support and we're down here. So there is clearly a rotation going on from growth stocks to into value stocks. But what we've got to look for is how much further down does it go? How does it turn around? All those sorts of things. Now let's look at some other charts, and I must admit this one really surprised me. So this is the Dow Transports. Sorry, this one's just not coming up correctly. Okay, so IYT. So yeah, this is the Dow Transportation Average. Now look at this chart. There was a bit of a sell-off last Friday before last, the 29th of January. But look at last week when the market really got hit. transport stocks just went up and up and up. They actually rose. They not only didn't fall, they actually went up and went up substantially. And that's a reflection of the fact that the economy is doing so well and all those other things that I just talked about before. So, this is an enormously positive chart for the market as a whole. It doesn't help tech stocks and growth stocks too much. But I think that they will find a level and the great stocks will resume their uptrend. Now, this is technology, the overall technology index. And the key thing to note here is obviously we had a bad start to the week and we were down heavily. But look at Friday. Look at the reversal on Friday night. Now, we need to see confirmation next week as to what happens from here. Does this follow through? How robustly does it follow through? That's the key thing. But there's no question there was a very nice reversal on Friday night. And if we look at some of the other charts, this is the S&P. Now, the S&P, nothing terribly dramatic really at the index level because this is obviously a mix of growth and value. So the S&P chart doesn't look too bad at all, and a very powerful reversal on Friday night. We saw the same thing with obviously the Nasdaq, right off support, right on cue. That's almost exactly to the support level, and then reversed very strongly. So needs confirmation, but certainly some positive signs. And even if we look at the small caps, that's a very positive reversal, and the small caps hadn't fallen that far. If you look at Thursday was well down here, but closed well off the lows. This was a market primed to reverse on Friday, and some pretty substantial volumes as well. So there is certainly some positive signs there in the US market from Friday night. Just while I think of it, let's look at Bitcoin, so I don't forget it. So for those interested in Bitcoin, this little ABC correction is what I drew out last week. I've left the structure in place. This was just to illustrate a point, but it's interesting that it bounced almost to exactly where I'd put that sort of arbitrary line. I don't know what Bitcoin's going to do in the short term. We'll just have to see how that plays out. But nothing has really changed from the comments that I made last week about Bitcoin, and that we may yet get a C leg that brings us back down to this support level around 40,000. Now, personally, I had a pretty nasty week last week because all I do is growth stocks. Really, I'm very, very narrowly focused on the mega trends. So I had a nasty week, and I gave back part of the profit that I'd been making for a period before that, and it hurt. But this is the vital bit, I'm so far ahead of where I would have been had I just been following, a broadly diversified index or something of that nature, that it's not funny. So the reality is we can't progress at the rate of high growth stocks and then only pull back at the rate of the index. So, you've got to, if you're going to be in growth stocks, you've got to take these periods of periodic volatility as just part of the game. So what it gets down to is absolute clarity about what you're doing, about what your investing and trading style is. And the clearer you can be in what style it is that you're using, the better off you're going to be. And I'll have more to say on that later in the presentation. Okay, let's move on to the US, the numbers for the US market. The S&P ended up actually rising for the week, 0.1%. It was almost flat, but it seems very, very strange after the week that we had to think that the S&P was effectively flat. The Nasdaq fell by 1.7, but look, it was down by more than 3% at one stage. Surprisingly, the VIX did very little, and this is another pretty positive sign for the market. The VIX hardly moved. So let's take a look at the VIX. So this was the spike that we had in at the end of January. This is the 27th of January. So we spiked up into the high 30s. And the market move particularly with technology stocks this time round, was nowhere near as it was nowhere near as severe then as it is now. Yet look what the VIX did. The VIX didn't even get to 30. It peaked at about 28 on at the end of February, the 25th, and then it peaked a couple of days ago at 28 again, but closed the week on Friday down at 24. So that again supports my sort of feeling that that this was really more about market makers just stepping back and emotional panic selling into a bit of a vacuum. You know, when you put the low VIX together with the low volumes, it just screams at me that institutions were not selling last week. This was the inexperienced retail punter that was selling into a bit of a vacuum. So I'm sort of encouraged by that. Now, just quickly, the other thing that I'll show you, if you look at the top chart here, this is the let's see what all the fuss is about with the Treasury yields or the 10-year bond yields. So let's look over the last week. So you can see that bond yields a week ago were about 1.4. They went up to 1.6. So it's the speed of change that upset the market. But let's put this in perspective. Let's go back 3 years and see what it looked like. So 3 years ago, the 10-year bond yield was 3%. We're now at 1.6. But you can see the turnaround that's occurred since August of last year. Let's just narrow in a little bit further. We'll come in and look at the last 12 months. So you can see we plateaued out and then we've started moving up. But in absolute terms, we're still at a relatively low level, but it's the instability being caused by the speed of change that's upsetting the market. The other thing that's upsetting the market is on this lower chart here, and this is the actual yield curve across all the different maturities from 1 month through to 30 years. And you can see here, this is where we were a year ago, the blue line. So you can see there was a bit of a mild expectation that interest rates would rise at the long end of the curve, the 10, 20, 30 year end of the curve, which is normal. But now you can see just how quickly the yield curve is steepening. So the expectations are that yields on the 10 and the 30 year are going to be significantly higher. And it's that rapid steepening of the yield curve that's upsetting the market. So the key to where equities go from here is pretty much purely and simply, will the bond market settle down, or will the Fed have to step in with some sort of even more massive stimulus? You know, that's the equation, and no one on the planet knows the answer to that question at this point in time. Okay, just look at the US dollar index. So you can see we're now in uptrend on the US dollar index. The stronger yield is drawing money from around the world back into the States. The US 10-year yield is outperforming the US German 10-year yield, and that's always a good relationship to watch. And so money is flowing back into the States, and that's causing the US dollar to rise. And I think there's a good chance that this is not just a blip, that this could actually be a reversal of trend, and I talked about that last week. Now, as a consequence, the Australian dollar perhaps has peaked out. You know, we've got the opposing force that commodity prices are doing so well because of global expansion of the economies. It's possible the Australian dollar has peaked out at 80, and we finished the week at 76.5. So the US dollar just under 92 is where it finished. The 10-year yield got up to 1.63, but finished 1.57. And there was the VIX. So if we look at the Australian situation, the Australian dollar 76.5, and it's really the instability in the bond market that's going to determine where all these currencies go. Now, our market actually went up by 1%, which is quite extraordinary, but helped by the banks and also by the energy sector. Tech stocks were absolutely horrid, but I believe big tech stocks, the game is nowhere near over for big tech stocks, that's for sure. The really good ones are going to continue to do well. There's just no doubt in my mind about that at all. But the important thing is the need for an active game plan in whatever market you're trading has never been greater, because we've now got so much stress in the system, and we've now got instability in the bond market, and we've got uncertainty about what comes next. I don't think people have ever been more uncertain about what comes next. Up until a couple of months ago, there was a feeling that interest rates would stay very low for as long as you could look out. But in the last couple of months, that's changed. That's the big game changer. And now it's highly uncertain what's going to happen. So it gets down to Mr. Fed and his mates as to what they do. All right, let's just look quickly at the Australian market, and then we'll go to the gold price. So there's the Australian index. We had a sharp sell-off the Friday before last. We got a decent recovery on the Monday, and then you can see we got a partial recovery on Friday. You can see it closed well off its lows. And I would expect that we'll see a pretty robust follow-through in the Australian market on Monday. Material stocks did poorly, particularly on Thursday and Friday. But the winners for the week, the other one that did poorly as well, this is healthcare. So healthcare got absolutely smashed, particularly CSL, sold down a lot. So healthcare, which is, CSL was, I'm not sure if it still is, but was the biggest market cap company on our market. CSL was down very heavily, so that took the healthcare index down. But the winners last week, energy managed to go up a bit. But the banks were really, surprisingly, were the ones that went up, or I guess not so surprisingly, with bond yields heading up. That's always a positive for banks. So that sort of rescued our market. But as I said earlier, I would prefer to be in growth stocks, capture the upside. Yes, I've got to put up with some short-term volatility, but I'm so far in front of the other way of doing it, effectively just trying to mirror the index, that I would rather just deal with the short-term volatility. All right, let's look at turn now to precious metals. Gold was sharply lower again, $33 down to 17.01, got down below that at one stage, and silver also dropped to 25 and a quarter. This was the worst month for gold since 2016, just to put it in perspective. There is a very strong inverse correlation between the gold price and bond yields, and it's starkly obvious in the chart that I'll show you at the next slide. And then obviously the rising US dollar contributed as well. So two significant negatives for gold. So no surprise that gold went down. But the long-term situation for gold, I don't believe has changed. We're getting debasement, destruction, whatever adjective you want to use, of the world's fiat monetary system, which is why Bitcoin and cryptocurrencies are doing so well. That I can't believe that long term, I'm talking the next 5 years, that the long term thesis for gold is still not really robust. But the short term is a completely different reality, and as I indicated last week, we could go down into the 1400s on gold from a technical perspective before this is finished. Precious metal stocks, they continued their trend downwards as well. So let's take a look at those charts. First of all, we'll look at silver. So silver's still holding up pretty well, because of the industrial demand and the very rapidly expanding industrial demand as well. So the 200-day is still moving up very strongly. The silver price is still above it. Yes, it's come down below the 50-day, but this is still a very robust setup in terms of the price chart of silver. But when we go to we'll go to gold first of all on a daily, you can see just the difference between gold and silver is just amazingly stark, and we're now clearly into downtrend on gold. Sorry, that's not the right one. There we go. So this is gold on a weekly chart, and you can see just how sharply we move down. Now, gold has made it down. These were the Fibonacci retracement levels that I put on here last week. So gold went down to exactly the 38.2, which was at 1688, and then bounced from there. My feeling technically is there's been a lot of technical damage done here. I think the 50% retracement is very much in play. That's down around 1570, and possibly even the 61.8, which gets us down into the mid 1400 level, is also possible. Now, there'll be bounces along the way. This is probably not going to go just straight down. So there'll be bounces, but I think there's a very good chance that the 50% level in gold, which is around 1565, that is now in play. So you don't want to be holding too much in the way of precious metals, because I think there's still plenty of downside potential left yet. If we look at gold stocks, they haven't been smashed to the same degree as gold has. So that's, I guess, one encouraging point. So I think the bottom line with gold, no matter what you think about gold long term from a fundamental point of view, we've got to respect the trend, and the trend at the moment is down, and it's down strongly. Now, this is the relationship, the inverse relationship between gold and yields. So on the top chart, we can see the gold price, and on the bottom chart, we can see the US 10-year bond yields. And you can see when one goes up, the other goes down. It's very stark, and the correlation is extremely high. If bond yields turn around and settle down, then gold stands a chance. But otherwise, it's not going to happen. Turning to other commodities quickly, gold went down, obviously, with the US dollar rising down to 4.01, and nickel slipped down into the mid sevens. We've now got a confirmed reversal in the US dollar, so that will certainly impact on commodity stocks. Crude oil was the big winner, which I'm scratching my head about, to be honest, but it is what it is. Crude oil up to 66, and I guess this is reflecting inflationary expectations and the resurgence of global economies. So there's the spot copper chart. You can see a bit of a sharpish pullback from the prior week, where we got up to about 4.2. The same with nickel. In fact, an even sharper pullback in nickel. So wrapping it all up, my final thoughts: if you've been caught out in the last week, in other words, you've still got too much exposure, you feel uncomfortable with it, particularly if the markets are going to have another leg down after a bounce, then you've got to remember there's always a secondary bounce, always. So don't panic sell until we get some sort of bounce, because it always happens. Now, if the bounce is strong, then you may not have to do too much readjustment at all. Although personally, I think right now holding some higher levels of cash is probably a pretty good move. But if the bounce is fairly weak, and what I mean by a weak bounce is short range candles that have got long wicks on either side of them, particularly on the top, so indicating that there's not buying conviction. If the volumes aren't strong, then if that's the sort of bounce we get, then we're probably going lower again, another leg down. So use that chance to adjust your exposure. The final point I would make is I think this is a very dangerous time, and I'm really talking about years from now. I'm not just talking about the next few weeks or next few months. I think this gets down to the style of how we trade and invest. I think we are now entering a long period where it's a dangerous time to be inactive, to just be a buy and hold kind of person, particularly if you are mostly in growth stocks, which I think most people have been drawn into the market by the attraction of being able to make big profits quickly. If that's the area of the market that you're in, this is a very dangerous time to be adopting a buy and hold for the next 3 to 5 years kind of mentality. It doesn't mean that you can't buy something really well and sit on it for a number of years. You can. What I'm talking about is the mentality. If you go in with that mentality, you close your mind to what the market is telling you. So just be prepared to be a bit more active and respond to the signals that the market is giving us. Many long-held relationships are broken, and the market is absolutely struggling to price those assets, whether it's in the equities market, the bond market, or even in in the precious metals market. A lot of those relationships just don't hold anymore. Now, portfolio analyst last week, again, there's been the opportunity, given what's happening in the market, for a lot of, I think, really good education. So for those of you that are looking to upskill, have more of an understanding of what the market is doing, then there's a lot of education in portfolio analyst. And again, we're still sort of shuffling the portfolios a little bit and doing quite a few reviews. So there's a lot in that service. That's it for this week. There's my email and website address, and I'll be back with you next week, and I'm sure it'll be another very fascinating week. That's it for this week. Cheers.